They say home is where your story begins, but in places like California, Florida, and Louisiana, that story is starting to end. Families who once dreamed of a backyard, a view, or a quiet street are now opening letters that say something unthinkable. We're sorry. Your home can no longer be insured.
More and more homeowners are abandoning home insurance because of skyrocketing costs.
Across America, entire neighborhoods, from wildfire-scarred hills in California to hurricane-beaten coasts in Florida, are quietly being abandoned. Not by people, but by the companies that once promised to protect them. This isn't fear-mongering. It's already happening, and it's reshaping what it means to own a home in the United States. In May 2023, State Farm, the largest property insurer in the nation, made a stunning announcement. It would stop accepting new homeowner insurance applications in California. The reason? Rapidly growing catastrophe exposure and rising construction costs. It wasn't just corporate language, it was a confession that wildfires, once rare, had become so frequent and so costly that the math no longer worked. Within months, Allstate followed. Then, Farmers Insurance began scaling back in Florida. Smaller companies in Louisiana went bankrupt altogether after back-to-back hurricane seasons. It wasn't a rumor. It was a wave. The Great Insurance Exodus. In just 3 years, more than a dozen insurers either went insolvent or pulled out of high-risk states entirely. And for millions of families, that left one question echoing through their empty mailboxes. If even insurance companies are too scared to stay, how are we supposed to? To understand what's happening, you have to understand how insurance really works. When you pay your premium, that money doesn't just sit in a vault. It becomes part of the insurance float, a pool of cash that companies invest while waiting to pay claims. The entire system runs on prediction, on the assumption that disasters are rare and that not everyone will file a claim at once. But what happens when disasters stop being rare? In 2017, the Tubbs Fire tore through Northern California, one of the most destructive in state history. A year later, the Camp Fire destroyed the entire town of Paradise. 85 lives lost, 18,000 homes gone, entire zip codes erased in a single afternoon. State Farm, Allstate, and others collectively paid out billions, more than they collected in premiums for years. And that broke the illusion. Insurance isn't about protecting homes. It's about predicting risk. And that math no longer adds up. At the same time, reinsurance costs, the insurance that insures the insurers, skyrocketed by up to 50%. Without it, a single bad season could bankrupt even the biggest player. So the math changed. And when the math changes, the promises start to break. The decision to leave isn't made overnight. It's born from spreadsheets, lines of red that stretch for years. For companies like State Farm, staying in California wasn't just unprofitable, it was existentially dangerous. In 2022, the company's underwriting losses exceeded $13 billion, the worst in its 100-year history. Executives knew something had to give. Raising premiums was one option, but in states like California, rates are tightly regulated. The California Department of Insurance must approve every price increase, and that process can take years. In the meantime, fires burn faster than bureaucracy moves, so instead of raising prices, they withdrew. Not because they wanted to, but because they couldn't afford not to. And once the first domino fell, others followed. In Florida, insurers faced $3 billion in hurricane losses from Hurricane Ian in 2022. By mid-2023, Farmers Insurance announced it would stop renewing policies for 100,000 homes. Some homeowners saw their premiums double, others lost coverage entirely. A few found themselves uninsured just weeks before hurricane season. One Florida resident put it best, "I didn't get hit by a storm. I got hit by my insurance company." For homeowners, this crisis feels less like economics and more like betrayal. In the small mountain towns of Northern California, retirees are watching decades of savings go up in smoke, not from fire, but from policy cancellations. One couple living outside Redding saw their annual premium jump from $1,200 to nearly $9,000 before their insurer pulled out completely. In Louisiana, families rebuilding from Hurricane Ida couldn't get new coverage at all. Some were forced into Louisiana Citizens, the state's last resort insurer, where premiums are 50% higher than the private market. In coastal Florida, small restaurants and shops are shutting down, not because of storms, but because insurance now costs more than rent. Strip away the numbers, and this isn't just about homes, it's about stability, trust, the promise that someone will help you rebuild when everything else falls apart. Here's the uncomfortable truth. Insurance is the first industry to fully price in climate change. Wildfires now burn twice as much land in California as they did 2 decades ago. Hurricanes are stronger, slower, and dump more rain than ever. Flood maps are outdated the moment they're drawn. Actuarial models, once built on decades of predictable weather, are breaking, so companies are rewriting them. They're shifting resources north, raising deductibles, adding exclusions, or exiting entire states. It's not personal, it's math, and that's what makes it chilling. Because when corporations start acting on climate reality before governments do, it reveals something larger. They don't believe the old world is coming back. In California, regulators are scrambling to keep insurers from leaving altogether. They're now allowing catastrophe modeling, advanced AI-driven risk projections, to set rates more accurately. It's controversial, but without it, more insurers will vanish. Florida has poured billions into a taxpayer-backed reinsurance fund, trying to stop a complete collapse, but that safety net is temporary and expensive. Meanwhile, real estate markets in high-risk zones are freezing. Without insurance, banks won't issue mortgages. Without mortgages, homes can't sell. Entire regions are quietly slipping into climate red lines, zones where ownership itself no longer makes financial sense. For the first time in American history, location isn't just a lifestyle choice, it's a liability. And here's the part few are talking about. Insurance isn't just about homes, it underpins the entire economy. Without property insurance, you can't build new homes. Without business insurance, you can't open new stores. Without insurance, banks can't lend, investors can't invest, and cities can't grow. In a sense, the great insurance exodus could be the start of something bigger, a slow-motion unraveling of entire local economies. Think about it. If homeowners can't get insured, they stop buying. If builders can't get insured, they stop building. And if no one builds or buys, the tax base erodes. Schools, fire departments, and infrastructure all follow. It's a chain reaction, hiding beneath the balance sheets. A quiet crisis that could reshape the geography of modern America. This isn't just a US story, it's a global one. In Australia, flood-prone suburbs near Brisbane are now labeled uninsurable. In Greece, after record wildfires in 2023, entire villages are being written off by insurers. In Canada, thousands of homes in British Columbia's interior are now deemed total loss risks. And in the UK, rising sea levels are forcing the government to create new state-backed flood insurance programs. What used to be called acts of God are now acts of math. And math has no mercy. The great insurance exodus is the canary in the coal mine. Not about whether a company can survive a storm, but whether an economy built on predictability can survive an unpredictable planet. Owning a home has always been part of the American story. It symbolized security, independence, and belonging, the foundation of the middle class. But that foundation is cracking. A new kind of map is being drawn, not by real estate agents, but by climate models. Areas once seen as paradise, the beaches, the forests, the mountains, are quietly turning into financial traps. Meanwhile, once overlooked regions in the Midwest and Northeast are becoming climate refugees. Safer, cheaper, insurable. The American dream is migrating, not just in spirit but in geography. A home isn't just walls and wood, it's memory, birthdays, laughter, quiet mornings. It's the foundation of a life. But for millions, it's becoming a financial risk too dangerous to touch. Some will move inland, some will stay and gamble, but all are realizing the same truth. When nature changes the rules, even billion-dollar corporations can't keep their promises. And maybe that's the most haunting part. Not that insurance companies are leaving, but that they're simply the first to admit what the rest of us don't want to believe. The storms aren't coming. They're already here. And for many Americans, the cost of calling a place home has never been higher. If insurance was humanity's safety net, it's starting to fray. And that raises a deeper question, one that goes beyond premiums and policy forms. What happens when the systems we built to protect us can no longer keep up with the world we've changed? The great insurance exodus isn't just about homes or companies. It's about trust in the very idea that we can plan for the future. Because if risk can no longer be calculated, then certainty itself becomes a luxury. And maybe, in the end, that's what climate change really is. Not just a crisis of nature, but a crisis of predictability. This was The Great Insurance Exodus, a story of climate, capital, and the fragile promise of protection.